Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that could be a bit confusing, misleading, and take you off course and have to make it actionable, understandable, and clear. What a week. What a show. I think the weather might just start breaking here in lovely Dallas, Texas. We've got football coming. If you thought that was the most important part of this week, you were mistaken. It's this show because we have a doozy. As excited as I am for football and cooler weather. 3 excellent data pieces. And guys, I think I found the greatest podcast episode, including my own, that I've ever listened to. And we're going to close up with that one. But at the 3 we're looking at today, we're looking at a Wall Street Journal article by Mr. Jason Zweig, one of our favorites. I got a lot of hits from the community, from the RHF Nation. Thank you guys for pinging me. It's always nice to know who's out there reading the news and pinging me to say, hey, put this on the show. I don't always put them all on the show, but when I get a lot of you, I put it on the show. So headlined, messing up the closest thing to a sure thing in the stock market. Yeah, we're going to need to talk about that one. And then I found a data point online this week, market cap at their IPO versus current market cap. I'm going to define those things. Just the total size, valuation of the company at the initial public offering when they issued public stock versus where they trade today. And it is interesting. And then in closing, again, the greatest podcast I've ever listened to, including my own, is here at the RHF Market Update Game, Recognized Game. This is Mr. Howard Marks and Morgan Housel, a friend of the show. You know who they are. Sent this over to me. It was so poignant and piercing that I printed out the transcript of the podcast, and we're going to focus on a couple brilliant comments made, but I recommend the entirety of this podcast, or I'm going to link it in the show notes, the transcript as well. I think you could bind this thing, put it in a book, and sell it, and it'd be a top 10 personal financial book of all time. So this is Howard Marks and Morgan Housel. Morgan Housel is a guest on Howard Marks' podcast, Behind the Memo, The Impact of Debt. Whew, I'm going to close with that because if I didn't close with it, I'd talk about it the whole time. Very powerful podcast. Very powerful. I aspire to have that level of impact. At the top, though, Mr. Jason Zweig. What do you think this is about? I bet you can already know. Subheadline, so the headline, messing up the closest thing to a sure thing in the stock market. Subheadline, index funds are a great way to match the performance of the market. So why do so many investors end up falling short? Now, for those of you who've listened long enough, you know what we preach here. Keep those costs low, investing simple, time horizon long. What rule was violated here? Time horizon long. So here's what's happening practically. In many instances, people are actually making the right decision. They're keeping their costs low. And in some instances, they're even keeping their investing simple. But why are they failing to actually keep pace with the market? Their time horizons are not long. They are buying and selling based on when they think opportune times to buy and sell will be. So there's a group called Morningstar that you may be familiar with them. They've historically been a mutual fund ranking company. They have a Starian system that was actually later ruled meant nothing, which is kind of egg on face. But they're an interesting group. They put together a lot of great data. But they have a study. So over the 10 years ended December 31st, 2023, Morningstar found investors in the aggregate, that's together, earned an average of 6.3% annually, or 1.1 percentage points less than the mutual funds and ETFs they owned. Guys, bring the children in on this one. You're telling me there's a 1.1 percentage point drag for investors from the ETF they own and their actual experience in that ETF or mutual fund. That's a problem. That is a real, we talk about how much costs matter. We talk about, well, you could be paying 0.03% for your mutual fund cost or 0.80%. And this drag surpasses all of that cost drag, timing drag. And it's a lot about patience. The article explains too many investors aren't patient. They're not patient. Buy and hold investors can turn into chasing hot returns. The article goes on and explains that the more you slice and dice the market, for example, you can have the S&P 500 or the Vanguard, total stock market ETF, VTI, or the Vanguard Total World, which is my favorite, VT. Or you can start to slice and dice, and you can do it by specific industry like technology or energy. The more you slice and dice, the less likely you are to hold on to your securities. The volatility is so significant, and the sector is so thin that it's just more difficult for us as humans, because there may be particularly, let's say, with energy, which has not done well of late, you might be thinking, it's over. Why do I have an energy? I need to sell it. It's down. I mean, it's not only down, but it'll stay down forever. We've met the enemy, and it is us. So be very suspicious of complexity. As you know, I like to keep it simple. One of the great lines Zwig has here, he editorializes a bit. He says, when you shoot for the moon with sector index funds, you stand a good chance of shooting yourself in the foot. Ha ha. Zwig is one of us. I'm not sure if he's a listener yet, but he's one of us. So, and I think this is a great reminder. This is a poignant line he gives at the end of the article. He says, first, remember that index funds aren't safe. Kind of reminds me of Aslan. Aslan's not safe, but he's good. Zwig says, first, remember that index funds aren't safe. They're just cheap. True. You can burn yourself as badly playing with matches as you can with a fancy lighter. And his summation is stick to the broadest possible index funds for nearly all your money. The narrower the benchmark the fund tracks, the more it will fluctuate, the more likely you are to get spooked out of it at just the wrong time. I like this line. I might need to get bumper stickers that say index funds aren't safe. Just to remind people, don't think you can just pile into index funds. It takes a little fortitude. And then briefly I want to discuss this market cap at IPO versus current market cap. So do you ever feel, listener, like you're missing out on the next greatest thing? Is there ever water cooler talk or family reunion talk where someone describes the initial public offering they bought, or even perhaps the private round that sometimes occurs before an IPO, where there's a round private investors can participate in? I want to go through a list that was produced. They're not all trading below, but most are. Okay, at the top they have Rivian, electric car maker. The market cap at the IPO is $87.5 billion. Today they're at $12.8. Airbnb, $86.5 billion market cap. Today $74. Coupang, $84 billion market cap. Today $23. Snowflake, $70 billion market cap. Today $43. Didi, $67.8 billion market cap at IPO. Today $19.3. Coinbase, many of you know Coinbase, the crypto brokerage, IPO'd at $65.4 billion market cap. Today it's only $13.1. DoorDash, $60 billion to $21 billion. On down the line. Even Toast. You guys, okay, you probably use Toast, which is a restaurant software platform. I actually really like their software. I went into a Mi Casino in Uptown, and I used a QR code to pay my bill thanks to Toast. Unfortunately, they IPO'd at $31.2 billion and now trade at $9 billion. So despite all their excellent software, Robinhood, we know their deal, $29 billion IPO, now at $7 billion. There are only two companies on this list. Mobileye, which I believe helps with autonomous driving, and Palantir, which is kind of an AI software fusion that works with a lot of governments. So those are the only two that are above their IPO, and they weren't above it by a lot. So Warren Buffett had a rule: he never buys IPOs because the fever pitch is the greatest at the IPO. But as an index fund investor, we don't have to worry about this. But it's a good reminder that sometimes it's okay to miss out on the next great thing. It actually saves you a bit of money. You keep using those index fund, listener. And now here we are. I've hyped this thing up. Oh, I probably used superlatives in my intro that you'd never heard of the RHF market update. I stand by them. I retract nothing. Here it is, the greatest financial podcast I've ever listened to in my 38 years of life. Excuse me, 39 years. Don't send cards, guys. Do not send cards. I turned 39 recently. Morgan Housel and Howard Marks. You could bind this and put this in a book. I'm just going to touch on some things, guys. Big picture, what are they talking about? Debt, the impact of debt, and how both of them think about debt. So you're having these two brilliant minds, Howard Marks being the famed stock picker investor, which of course we're a very big tent right now. We're letting him in the tent. And then Morgan Housel, The Psychology of Money, one of our Mount Rushmore of personal finance, along with Bogle and J.L. Collins. So having these two minds together was just fascinating. I want to read, so they're just having this dialogue. I want to read to you one of Morgan Housel's comments about debt and the range of volatile outcomes you can actually survive. So listen to this. This is Morgan Housel, the author of The Psychology of Money. He says, and to me, it was the more debt you have, the narrower the range of volatile outcomes you can endure in life. All investments, you get paid for two things. Two things in investing. One is mispricing. The other is the endurance of volatility. And when you view debt as a narrowing of the outcomes that you can endure, it really takes on a new level of significance. Wow. That is brilliant. Bring in the children near the radio on this one. Let's go back. You get paid for two things in investing. I found this fascinating. Okay, so what are the two things you get paid for, according to Housel? Mispricing, meaning you're buying something that's worth $1 for 80 cents. This is what Buffett tried to do, particularly early on in his career. He called it cigar butt investing. But you're really finding the market, mispricing assets. Well, as an RHF listener, you know that's not primarily what we're doing here. Well, what are we doing? Endurance of volatility. Okay, beta. You're simply riding the roller coaster and staying on, but you're getting paid for that. So what he's saying is when debt comes in, you narrow the outcomes you can endure. That is so true. It is so true. And then Housel goes on to explain this, and this is piercing. He says, virtually every investor says I'm a long-term investor. Oh, all right, listener, think about yourself. Are you a long-term investor? I'm a long-term investor. That's one of our three monikers. Keep it time horizon long. Of course we're long-term investors. But you aspire to be a long-term investor. Most people will give homage to that. They will, of course, tip the cap and say yes. Here's what it really means, though. Housel says this. What that really means is you have to do is be willing to forego shorter-term gains. And that is much more difficult to do. You see that? It's easy to say I'm in it for the long haul. It's harder to say I'm going to go the next 1 to 5 years below my potential. Did you hear that? I'm going to read it again. I'm going to go the next 1 to 5 years below my potential. Now, do you see that connection? Housel says that's where people get tripped up. Because why? What does that mean? Housel says I could be leveraged up here and earn more over the next 1 year or over the next 5 years. It's going to make me less durable. If I can stick around for the next 30 years, the returns of that compound to what are going to be absolutely extraordinary. Brilliant. What Housel's saying is you have to be more excited for the 30-year run than the 5-year run, and therefore underperform, because of course you could borrow money and improve your returns. Of course you could. You risk the 30, which is actually where the real money's made. He who gathers little by little will prosper. Wealth gained hastily will dwindle. So whenever someone says, I have a way to make money quicker, I do think of that verse. I think, I don't know. Here's Housel, just nothing new under the sun. He's echoing scripture. There's a great phrase that Housel connects with a group called PIMCO, which is a famous bond trader. They had a phrase called strategic mediocrity. I really want to change the moniker. Robert Hunt Financial, the home of strategic mediocrity since, 2016, 17. The home of strategic mediocrity. Because you have to be willing to not maximize your options in order to have a long-term framework for investing, which is where the real success is. And there's a story that Housel gave, a guy named Rick Guerin. I don't know if you've ever heard of Rick Guerin. There was Warren Buffett, Charlie Munger, and Rick Guerin. It was the three of them. Guerin recently passed away. But it was those three. That was the trio. Eventually, now it's the duo. Charlie Munger's passed away, but it's Warren Buffett. What happened to him? What happened to Guerin? Well, He invests on margin, meaning he borrowed money to buy stocks, which allowed him to probably do better than Buffett in a 1 to 2 to 5 year frame. He was probably beating Buffett, probably doing the same stuff. Same stuff. But what happened? Well, there was someone who asked Buffett, hey, what happened to this guy, Rick Guerin? It was the three of you guys. What happened to him? And so Warren Buffett told a story, as he's wont to do. He said, Warren, Charlie, and Rick, they made the same investments together. They made the same picks. Rick did one thing different. He invested very heavily on margin. And it was the 1974 bear market. He got clobbered. Now, Warren Buffett had a great saying. He said, Rick was just as smart as us, but he was in a hurry. Bring the grandkids back in for this one. Rick was just as smart as us, but he was in a hurry. He wanted to get rich quick. Incredible. So I could read this in the entirety of this podcast, but what it did for me, what I hope it does for you, I forgot the degree to which I kind of forget how exciting long-term investing is. What I think Housel, some of his magic is he takes what should be a really boring concept, which is long-term investing, and simple balance sheets and no debt or low debt, and he makes it exciting and energizing. Because guess what? Nobody else is doing that. Nobody. CNBC, Wall Street Journal, swig notwithstanding, most of what they talk about is what happened yesterday, what happened this week, what's going on. NVIDIA's earnings, they just got released, yada. It's all. But to be excited for what can happen over a long period of time, that's what it takes. That's what it takes. And so, Housel, I'm going to skip ahead here to the very end. I hope you give it time. But what he talks about is maximizing for endurance. So it's a different way of thinking about life. So a lot of people think about maximizing returns. In fact, a lot of meetings I have, we're talking about how do we maximize returns? How do we? And actually that matters. That's a conversation that matters. A more important conversation is maximizing for endurance. So this is Housel's quote in here. He says, I just want to maximize for endurance because I know that if I can be an average investor for an above average period of time, it's going to lead to extraordinary returns. Do you hear that? If I can be an average investor, I just want to be average, but to do so for an above average period of time, that's the juice. That is the juice, is time. And he says, it's just pick the variable that you want to maximize for. The vast majority of investors want to maximize for returns. That's the knee-jerk reaction. And of course, that's what you should do. But for most investors, that's not what's best. What you want, this is Housel, what you want are the best returns that you can sustain for the longest period of time. Wow. Now that is truth. Put that on a bumper sticker. What you want are the best returns you can sustain for a long period of time. Guess what, guys? That may mean you don't invest in the stock market at all. I think that's part of the work of a good financial advisor is diagnosing what you can handle. And for many people, the volatility is too much. You got to find something, find some game you can do for 50 years. That's the ticket. So, what a podcast. Thank you for listening to this podcast. And as always, keep those costs low. Keep that investing simple. Keep your time horizon long because that's what's going to give you the best shot on your investing journey. Until next time.